The same house in Philly or Dallas or whatever market you're in 2018, you could buy at about an 8% capitalization rate, right? In other words, if you invested all cash 2018, then all of a sudden today it's worth $200,000. And the reason that it is because a disparity of rent lift and expense lift. In other words, expenses way outpaced the rent increases.
All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an interesting guest today. I wanted to have him on the show here because he is a note expert, and I am not. I've actually, we've bought notes before, but we really don't specialize in that, but I know people are making a lot of money buying, trading, selling notes, and his name is Eddie Speed. How are we doing today, Eddie?
I'm good. How are you?
I'm good, my friend. I'm good. I was impressed with your bio. Over 50,000 notes you've purchased and traded. That's incredible. We've bought notes a few times here and there. We bought one at auction a little while ago on a condo in Philly and took like title of the asset. And then we had to clear out a few other notes. But man, I don't fully understand the note business. And I just want to have you on the show here to drop some knowledge on us. How's that sound?
I'd love it. Yes, sir. Thank you.
Absolutely, absolutely. By the way, a quick piece here to our listeners and our viewers. If you're enjoying our content, please share it and like and subscribe. We're always looking to reach more people here with more content. So we're going to talk about how you can buy notes, how you can invest in notes, how you make profits investing essentially in promissory notes. So these are that's the money you owe to the bank, or the lender. And when you're buying a property, if you own a home, you signed a note probably to buy that property. You borrowed money from a bank. And, maybe you're paying 3% interest, maybe you're paying 6 or 7% interest. But so how do people really make money in this business? Eddie, let's maybe start from the beginning and just give us a quick summary of how you got started in this business. Then we'll kind of go into a situation of how you buy and make a profit on a note.
Well, I'm an old guy in the business, right? I'm 65. I started when I was 20 years old.
Wow.
So I've been doing it a very long time.
Mhm.
I started when seller finance note buying really was a really big thing, and that was because, inflation,
Mhm.
right? That's really in the 1980s, that's what drove this incredible mountain of seller financing, which is really what formed our industry. Other than
Mhm.
that, there was just people that bought a note every once in a while, but there really wasn't an industry. And so that really is, I got on the ground floor of that just accidentally. It wasn't like I was a smart guy. I stumbled into the idea and got coached by a couple of guys that were industry pioneers.
Mhm.
So I got very lucky that, my junior high football coach was Michael Jordan, so to speak,
Wow.
right?
Okay.
And so that was luck. And I moved to Dallas Fort Worth in 1982.
Mhm.
And my wife and I married, and we started this journey of buying notes. And several things happened. A guy that I met in the later 80s, probably 87 or 88, was a guy named Ken D'Angelo. And I bought some notes from him. Ken
Okay.
D'Angelo founded Homevestors, right?
Okay.
And so then I developed the note system in its very infant stages of Homevestors and did that for about 10 years for them. And that's how I bought so many notes. Like you asked me before we started, you're like 50,000 notes? Like really? Like you're not sure if that's really true or not? And the answer is I developed a note manufacturing system for real estate investors.
Mm.
That's how I did so many notes
Mhm.
because you create then notes to a formula. You create notes to a system and they're all they look the same and they're done in a way that is what the banks and the institutions and the hedge funds want. You don't write them on land contracts. That's not cute, right? It's not good in the secondary market. So that's the things and so here I was after I'd taught all this to a lot of people that, had done a lot of volume and notes. And then all of a sudden, here I am in around 2000, now 25 years ago. I said, what I really need to do is have a school because if you could teach people how to do this, then it would really help them and it would also create a system where people could then sell notes to us or whatever. And so that's kind of how I got down the lane. I'd been doing the business literally for 20 years before I formed a school.
Wow.
But that's been the intention of the school, and there's been different market eras, obviously. So, we've lived through, the early 2000s and people kind of losing their minds and anybody can get a loan, and everybody needs to buy real estate to then all of a sudden we went to 2008 and oh my God, everybody's, left town and, the bank debacle. And then boom, we built back up and rental properties were half price.
Hmm.
And, then all of a sudden we went through that. Then all of a sudden we went through the virus and everybody lost their minds again and they started paying too much for property. This seems like a cycle.
Hmm. Hmm.
And so at this point in my career, I can see segments in the cycle much quicker and easier than I could when it was the first time I'd ever seen the forest fire. Now, I'm not
Yeah.
saying they're not different at time to time, but there are patterns that are the same.
Hmm.
So here's a couple of things I figured out. At the moment, people aren't making money out of rent houses,
Hmm.
right? The same house in Philly or Dallas or whatever market you're in 2018, you could buy at about an 8% capitalization rate, right? In other words, if you invested all cash, and we're going to use some really easy math, although this would be too cheap of a house, but if you
Hmm.
invested $100,000 in the house
Sure.
in 2018, excuse me, 2018, then all of a sudden today, it's worth $200,000.
Yeah. Right.
It actually made more profit in 2018 than it's making today.
Mm.
And the
Mm.
reason that it is because a disparity of rent lift and expense lift. In other words, expenses way outpaced the rent increases.
Mm.
Call it 2.5 times more.
Mm.
And so that is what caused the situation. And the result of that is that extra $100,000 in equity that your house gained is an equity that you're not getting paid for.
Hmm. Hmm.
Call it trying to eat an equity sandwich,
Okay.
right? So that's just a market condition. Eddie didn't make that. Aaron didn't make that. That's
Yeah.
just what the market is.
Sure.
I come in and I'm in several real estate masterminds that probably most of the top 500 house buyers are in one of those masterminds.
Hmm.
So if you go in those masterminds, there's Eddie Speed, the note guy, like old
Hmm.
dude, been doing it forever. Has
Yeah.
most people have the same reaction you did? 50,000 notes, how in the world, blah blah blah,
Right.
right? And there's market areas where I don't really offer that much to masterminds because they're just doing something else.
Right.
Now all of a sudden I walk in and you have a real estate portfolio and you're a landlord
Hmm.
and own a $250,000 house that rents for $1,800 a month, you're netting $900 a month before debt service.
Mm.
So your $250,000 collateral is making you $10,000 a year.
Okay. Yeah.
You take $250,000 and you go buy first mortgages on property,
Hmm.
you can make, you know, $30,000 a year, $25,000 a year on the same investment dollars, just investing in a different asset.
Hmm. Okay.
You
And
can
that's just
sell it.
interest, you're saying.
You can
Interest
sell or
on.
finance your property instead of renting it. Same property.
Hmm.
Now all of a sudden I'm gonna get rid of it as a rental, but I'm gonna sell it, and now I'm gonna be the bank.
Yeah.
There is a reason that the tallest building in most town is the bank.
What about the church?
Well, it's usually not taller than that multi-story bank, and I'm not taking anything away from the church, right?
Depends on the town, right? Depends on the town. Yeah. Hmm.
Yeah, let's take a big city, right?
Okay.
So the idea is really this.
Yeah.
The idea is that none of us did anything right or wrong,
Hmm.
but we were programmed since after 2008 that the way to earn long-term wealth in real estate was rentals. And
Hmm.
that's what you did, and that's how you do it, and that's how all these stories and people, that's how I did it.
Hmm.
The answer is I now have 4.5 decades in the business, and I could see that was a good strategy because real estate was on sale.
Hmm.
Now we're in a market era where the house that you buy is not going to produce you even close to the income it should be producing. So it starts triggering, like, what should I do?
Mm-hmm.
Is that the same? Wait a minute. Has somebody moved my cheese?
Mm-hmm.
And I believe that's just the market era that we're in. So if you owner financed an identical house, right? Owner finance it versus renting it. That house, if you owner financed it with a good down payment of about 15% down, is a payment of about $2,000 a month. Now remember, you took some of the money off the table because you got like a 15% down payment.
Mm-hmm.
And if you took the capital you still have in it versus the capital you have in a rent house, you're going
Mm-hmm.
to find out that the math is pretty true at 2.5 to 3x, two and a
Mm-hmm.
half times to 3x the return to be the bank versus a landlord. And it goes back to this. Okay, well, you say, well, what are the terms of these loans, Eddie? Tell me what that is. 40% in the residential housing market, 40% of loan originations are non qualified mortgages. They're not Fannie Freddie. They're not FHAVA. They're non QMs.
Mm-hmm.
I'm just showing you how to create non QM loans. And those
Mm-hmm.
rates are higher.
Yeah. Well, okay, let me jump in here for a sec. So I'm just thinking about the real estate I own. I mean, the cash flow is not where we make the money. We make the money through refinancing the asset over time. And if the value of it doubled over 8 years, which a lot of it did, I mean, we're laughing all the way to the bank, as we refinance and harvest that equity growth through a refinance. It's tax-free distribution right to my bank account. Um,
As long
so
as it
when you
cash flows.
What was that?
As long as it cash flows.
Sure, sure. Yeah, we buy, multifamily real estate. The rents have gone up significantly on these assets, so the debt service coverage ratio is strong. And you wait 5, 6 years, you have some equity growth, your rents go up significantly, say 5% a year. So, rent growth grows by 25%, property value grows by 25, 35%. You harvest that equity growth over time. So that's generally how we make money on these properties. But let's say, I'm trying to take a back seat and not be a landlord, right? Because there is a value to holding a note and having a true passive income, right? Because I have a management company. I know how much work it is to be a landlord, and have a management staff that manages these assets, and it's a lot of work. So I do like the idea of being the bank and holding the note. But you have to own the property outright or have a very small loan amount on it, right? Like if I have most people leverage
No,
their,
that's actually where I come in,
yeah.
right? I bought 50,000 notes. So
Hmm.
if I get you to manufacture the right note,
Hmm.
and then there's a lot of ways I can show you how to recapitalize and get enough money to pay off the underlying debt, but yet keep cash flows out of it.
Hmm.
So you're do most people have rent houses, they do it because they wanted to earn cash flow. They wanted to earn wealth.
Hmm.
They just the economics became very different. And so that's the point of me having a school. That's the point of me having kind of a directive of let me help you manufacture your notes. So that
Hmm.
then they're creating notes that will fit the institutional market. So here's
Hmm.
some fairly easy math. I might come in and buy 70% of your payment, not 100% of your payment. I'm going to buy 70% of your payment. You create a non QM loan at a non QM loan rate. I might fund 80% of the amount of your principal to buy 70% of your payment.
Okay. So then,
Now, now you start to realize, like, wait a minute, Eddie's kind of put me in a position where I could act like a mortgage bank.
mhm,
Like, and it's because we created paper that fit, a defined market, and
mhm,
not Fannie Freddie, but it's still a defined market.
mhm,
And so that's where I come in and help people do it. So yeah, then you can have underlying debt and you can pay it off and do those kind of things. And you'll be quite surprised at how some of this stuff models.
okay. So I own a property, and just for numbers' sake, it's worth $100,000, and I bring in a buyer, and let's say I owe on the mortgage $70,000. Okay.
Yep.
I bring in a buyer. At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. He's willing to put down 20%, and he's going to sign a note for $80,000. Before I sell the asset to that buyer, I'm lining up a buyer for that note, so essentially
That's
warehouse
me.
line.
That's me.
Okay. So I line up you to buy the note. The note's worth $80,000. It's going to make, whatever, $1,000 a month in interest. Okay. And you say, I'll pay you $80,000 for that note, but I want $700 of that 1,000 every month. Okay.
Yeah.
So now I sell you the note for 80,000. That covers my mortgage amount of 70,000 or so. So I pocket a little bit on the sale of the note, and then every single month I'm pocketing a little override, about $300 on that note payment.
Yep.
That buyer of the property now, closes on the asset, kind of simultaneous closing, selling the note same day the buyer's buying the property, so the money comes in to pay off the original lender on my property. And now I'm no longer the landlord. I don't have to worry about tenants' toilets or trash. And if the buyer doesn't pay me, I could foreclose and take back the asset because I'm in a first lien position. Well, actually, you are. I'm just.
Well, that doesn't mean you can't buy out my interest. You can buy out my interest and foreclose. We're gonna create an underwriting box that probably is going to say that you're looking at a default rate that is not terribly high, not very high at all.
Mm-hmm.
Like, if you have Fannie Freddie's default rate, which is 2 to 3%, we want to be
Mm-hmm.
right above that number, right? We
Mm-hmm.
don't want to be way up here and your default rate's 8 or 10%.
Mm-hmm.
And so the way you do that, like every other aspect of underwriting, which you're a professional landlord and you know this, is you just tweak the underwriting to say, this is my target acceptable customer.
Mm-hmm. Mm-hmm.
And so in most cases, it's going to be the case. And here's the thing about it, Aaron. Let's be honest about it. Like, the multifamily thing has had quite a cycle that's been forming, right? And it doesn't mean that it's bad, but it means that it's not the big, hockey stick straight up like it has been. And so
Mm-hmm.
for some people, they're just saying, what about an alternative? I'm not trying to take anybody out of what they do every day.
Mm-hmm.
But like if you did an alternative right now, if you did an alternative,
Mm-hmm.
notes would be a very good alternative to what you're currently doing. Look, you've already figured out how to raise money,
Mm-hmm.
right? And so there's a way to go structure and point your asset, your capital raising machine, but just at a different target,
Mm-hmm.
right? So that's for the syndicator guy. Like syndicator guy, right? Like I already know that story. I mean, I've got a ton of people in note school
Mm-hmm.
that came from the syndication world.
Sure.
And
Yeah.
once again, they find something that's an alternative that gives them a cash flow model that might be, you know, different than what they have. If
Mm-hmm.
you're a rent property guy
Mm-hmm.
and you have rentals, it's pretty simple. Like now you're trying to say like, okay, if I have this house, what's the most profitable thing you can do, right?
Mm-hmm.
And the most profitable thing you can do. And by the way, I mean, for whatever it is, like let's just say the analogy that I gave you a while ago, $250,000 house. Maybe that's too cheap in your market. Maybe that's perfect price range. But
Mm-hmm.
we're talking about a decent house. We're not talking about a piece of junk. It's not in the ghetto, but it doesn't have to be an executive white collar house either, right?
Mm-hmm.
It can be.
Mm-hmm.
It's okay to be working class,
Mm-hmm.
and and so this house nets way more money per year. The example that I gave you on $250,000 house with a
Hmm.
15% down payment, not 20, but with a
Hmm.
15% in the first year, you get $50,000 more money
Hmm.
doing a note model than you will renting. In 5 years, you get $100,000 more,
Hmm.
right? So it's kind of like what you're saying, like you're getting more money, so it's a way to have access. And as you said, you refi and do whatever. Now, once again, it's all relative to rates. At the moment, I'm not saying this is always true because it certainly would have, what I'm saying may not have been true in 2016 or 18, but it is today because rent houses are making way less profit, right? But what I will say to you is you go stand up a Burr model on a house at the moment, I'm going to
Hmm.
say notes is probably going to kick its butt.
Hmm.
Same
Yeah,
numbers, same math, either way, it's just more profitable to note it than it is to do it as a Burr.
right, right. I could see that. I mean, generally single family homes, I mean, anything less than like 50 units for us, it's hard to cash flow on 40 units, maybe anything less than that. Um, generally it's about a 5-year investment, right? We're refinancing by year 3 or 4, we're selling by year 5. There is cash flow along the way, but that's for apartment buildings. Apartment buildings are nice right now because rent has really grown. And with interest rates high, apartment buildings have come down in cost. So that's a good market. But if you're talking about single family homes or duplexes, yeah, I mean, there's not a lot of money to be made in them right now with where interest rates are at, where prices are at. By the way, in North Jersey here, 250 grand isn't getting you much, maybe
No,
a
no, no.
maybe a
I'm
one
just
bedroom
using an
condo. Yeah,
analogy.
yeah, I know. I'm just
Like
extending.
I'm not trying to do it to any local market standard, you know.
Yeah, yeah, yeah. But I understand what you're saying. That's interesting. And so what you do is you teach people exactly how to do this, how to paper up the notes, and then you even offer to buy the properly done notes. Is that right?
So I teach people how to create notes or buy notes,
Okay.
right? Either one. Like in your case, to be honest with you, if I'm tracking with your story, let's just say, you know what? Eddie's right. I've raised, you know, all this capital and I
Hmm.
bought all this multifamily. What
Hmm.
if I like decided to own a note portfolio and use some of these leveraging techniques that Eddie's talking about?
Mm.
You use leveraging techniques when you buy a multifamily, don't you?
Yeah, sure. You leverage every
Okay, well
dollar
then
you
you
raise.
can you can use some of these same leveraging techniques.
Hmm.
And once again, you have people that come to you and say, "Look, I don't want any brain damage. Just here's my money. You figure out what to do with it and stuff." And you say, "Well, look, I'm going to diversify and point my gun not at just multifamily at the moment. I'm going to point my gun towards opportunities with notes, which
Hmm.
I've had a lot of multifamily guys do." So
Hmm.
there's kind of like it depends on which seat somebody's sitting in as to which advantage that they start pursuing,
Yeah.
right?
Hmm.
I'm not probably not somebody comes to me with 100 rentals. The odds are not very high that
Hmm.
I'm going to convert all of their 100 rentals to notes. But I will bet you almost anything that I can show them the math is very logical to say convert half of them.
Mm. Hmm. Interesting. So do you do that as a service? So like we own like about 30 properties or so. You look at the portfolio and you might say, hey, this one makes sense or this one
We
doesn't, Yeah.
we
Hmm.
use it a hybrid between using the school
Hmm.
because that way it keeps my mortgage company out of the education business.
Hmm.
So we utilize the school versus we utilize that we have a system that somebody follows. The biggest thing I do in seller financing is I give you the formula of how to do it and vendors to help you do it,
Hmm. Hmm.
right? In other words, you're saying I don't have anybody in my office that knows how to do transaction coordination for a seller finance deal. I already know that. And
Hmm.
neither does anybody else. I mean, for the most part, right? So
Hmm.
I create a vendor system of somebody that oversees the transaction where you end up being able to sell the note because the note is created to the recipe that we've given. If I
Hmm.
give the recipe to somebody that's not, well intended, but not as experienced, then all of a
Hmm.
sudden it seems to somehow get off track a little bit.
Hmm. Well, it's all about underwriting, finding the proper borrower, underwriting them properly, getting the note structured so that you can essentially sell it. You already have a buyer lined up because you need to sell it as soon as it's signed to pay off the lender,
That's right.
the who's originally on title.
Yeah.
Um, and so you're really just creating a note that is sellable and desirable, um, and then kind of creating an override on that note. Yeah, it's interesting. And then as the note gets paid off, um, I guess that's so you collect, what do you do, like 30-year amortization on these notes generally?
Yeah, for the
So you're
most part.
collecting a paycheck for 30 years, or they sell the property at some point and you get a lump sum payout. Right.
So
And
just like your industry math, you're saying your normal refi is a 5 year target, right? So
yeah,
normally you look at a loan paying off in about 8 years, right?
yeah.
That's not always the same because there's no refis at the moment. There were a mountain of refis in 2022, right?
Yeah.
So it
Yeah.
won't always cycle the same, but
Mhm.
within a 10-year cycle, it's likely going to cycle.
Okay. Do you do a prepayment penalty so you make sure you at least get
No, you're selling to consumers, and so you got to be really careful about like punishing them to pay off the loan.
right, right, right.
You can put a light prepayment penalty in it, but it's not like this isn't a hard money loan. Like
Hmm.
the rates are high. They're
Yeah.
higher than people think. They're probably 10 or north.
Oh, okay. Wow.
But
So
that's
these
what
are
non-QM rates are.
right. So these are for borrowers that couldn't really get a regular loan or like
For
it,
40%
mhm,
of loan originations today on the resi side,
mhm,
40% of them are non-QM loans.
mhm,
Underwriting is as big a problem in the loan origination business today as rates are.
mhm. Aren't they just going to refinance if rates drop next year? I mean, you're at 10% and rates drop down to
Not unless
five.
underwriting changes, they're not.
Yeah. Okay. It's interesting. And if they do refinance and pay off the note, I mean, you really, it's tough because the longer they pay the note, the more money you earn. Like you don't want them to you don't want
Well,
to pay off the note, right?
okay. I mean, the loan pays off, and I've taught you now how to buy notes. Then you
Hmm.
just go buy a note and replace the income.
Ah, okay. Okay. Right. All right.
People think I never have any interest in buying notes. All I ever want to do is create notes on my own property. But the
Hmm.
longer they stay around the cycle, they're like, hey, wait a minute. You mean that if I got my income that paid off, now all of a sudden I can just turn right around and redeploy the money into a next note? And I'm like, yeah.
Hmm. Hmm. Okay. Okay. Interesting. Well, I gotta say, Eddie, you got an interesting business model there. I've learned a lot from this podcast, and shoot, I'm about ready to sign up for the note school over here and become a note whiz.
Well, I will tell you that there's probably a lot of people that from that space that have done a lot of that, and really it's just because of market cycles, right? Every dog has his day, but we're in a pretty good there's a pretty good runway in front of us for notes right now.
Mm-hmm. Hmm. Yeah, well, because rates are so high, but so you got to play the market there. Yeah. Well, and what do you do when rates are super low? And you're locked in like a low rate note that no one wants to buy.
Well, I mean, I don't create low rate notes.
Hmm.
I mean,
Yeah.
when rates were 3%, I wasn't creating 5% seller finance notes,
Right.
right?
Right. Right. Yeah.
But once again, I mean, it's cycles, and so the note buying business wasn't great in 2022,
Hmm.
but it got really better by 23.
Hmm.
So
Interesting.
understand that I, I'm in one of those businesses when everything is really, really great, it's not great for the distress side of the business.
Yeah. Yeah.
How when notes are needed is when there's distress in the mortgage industry,
Yeah.
right?
Hmm. Hmm.
And if you look at the cycles, it's almost 50-50
Hmm.
as to whether everything is great or there's distress in the market. I
Yeah.
mean, I'll bet as you see some distress in this multifamily, I bet you're licking your lips going, I can't wait for the distress, right?
Oh, everything's on sale, my friend. Yeah, I'm out there buying. So I'm that right now is a great time to buy properties for discounted prices in the commercial space. Not so much the residential space, but in commercial for sure.
Right. So once again, it's the same thing,
Mhm,
right? You can make money on both sides of the market, and
mhm,
that's what I do is make money on both sides of the market.
mhm.
We've got uh when they create this inventory of notes,
Yeah.
when they create a big surge of like seller financing, you're going to pick off that pile for like years. Like not every loan's going to get traded in the marketplace. And so all of a
Mhm,
sudden there's going to be this inventory of notes, and somebody a year and a half from now, or 3 years from now, or 5 years from now says, well, I want to go do something else with my notes. So anytime we see a big amount of inventory created, it's not like, well, you get an immediate benefit from it and you'll get no future benefit.
mhm, mhm.
Like
Yeah.
the notes literally that were created in early 1980s, which
Mhm,
was really honestly, about a 3 year span. We
mhm.
picked off those notes for 10 or 12 years.
Oh, interesting. So they get refinanced less than you
Not
think.
everybody needs the money at the same time.
Yeah. Yeah, exactly. Okay. Well, Eddie, how can people find you and learn more about what you do there?
The best thing to do is I want to give your audience a little class. Now, I've got a lot of deliverables, spreadsheets that you can run modeling on your own rentals, a book like answering about 150 questions about people have about notes and stuff. But along with all those great materials, we've got a class to kind of go through and show modeling and show what's possible and stuff. It's the
Well,
best way for somebody to spend a limited amount of time, call it a couple of hours or an hour and a half, to go
mhm,
figure out like, am I a candidate for this? Do I like it? What does it look like? So anyway, it's noteschool.com/passive CF. Obviously, it stands for cash flow.
mhm,
And
mhm.
and we do, we see a lot of, people like from an audience like yours that kind of come in and I'm not really sure,
Yeah.
this seems like it and stuff. And so hopefully I think we do a pretty good job of kind of giving them the ESPN version.
Yeah, that's great. That's great. And so is that a free class or that's part of
It
your
is. It's
wow.
it's we do sell it, but I'm giving it to your audience for free. It's virtual.
Yeah.
And
Yeah.
so you go in and enter it, and it gives you the class time and date. It's a real class. It's a real thing.
Sure. Wow.
And so one of the guys on my team that actually runs our marketing is real good at making it simple.
Yeah. Yeah.
And but it's a very informative class. I get a lot of compliments on how informative it is. It
That's
moves like we do it live, so it's
yeah.
like, what might have been the most relevant thing, 2 months ago may not be so relevant now, and so it's very
Sure.
relevant to the market.
That's great. That's great. That's a beautiful thing to hand out to our listeners here. What's that website one more time?
It's noteschool.com/passive CF.
That's great. Yeah, we'll put that in the show notes as well for our listeners so they can go check that out. I mean, what do you have to lose? I mean, the worst case scenario, you learn about note trading here. Maybe it's a fit for you, maybe it isn't, but that's very nice, yeah, Eddie. That's good to hear. And I think myself, I'm gonna try that out and learn more about notes here. We are in the business of raising capital. We've raised millions of dollars and we've done hundreds of real estate transactions. So I think I'm
Awesome.
sharp enough to understand this business. I've seen other people do well in it, and I'm curious to learn more myself. So I'll look into that also. And to our listeners that are enjoying this content, hopefully you got some serious knowledge dropped on you today from Eddie Speed here. And share it. And if you like it, please like it as well. If you find value from our Passive Cash Flow podcast here, you can share it on all the major platforms that podcasts are found on, and YouTube as well, where you can subscribe to our channel, the Passive Cash Flow podcast and People's Capital Group there. As you know, my name is Aaron Fragnito. I'm one of the co-founders of People's Capital Group. We help people build and preserve their wealth in New Jersey apartment buildings. And Eddie, boy, if I keep watching your content, who knows? Maybe one day I'll say we help people build and preserve their wealth through New Jersey apartment buildings and notes. Who knows? That could be part of the future investment here, right?
That's awesome.
Absolutely. So thank you so much to our listeners. I'll put that link in the show notes so you can get Eddie's awesome offer here, and keep listening to the Passive Cash Flow podcast. Thanks a lot, my friend. Have a good day.